Harry Dent for the Rant on October 18th. First, for people that did not see my tribute to Rodney Johnson yesterday, look back for that. Rodney did finally die in his battle with brain cancer on October 11th, and we are so sorry to see him go, and everyone, all of our subscribers and all of his friends and acquaintances will miss him sorely. Now for today, I think what I'm working for in the November issue of the newsletter is to really look at this massive, unprecedented, beyond comparison stimulus program we've had since 2008. What I've documented is the $27 trillion program, okay, over 15 years, and it's still going. You know, the monetary part has pulled back, but the deficits are still going. So this is unprecedented, and of course it's affect our economy enormously. So the November issue I'm going to look at best I can, because there's no way to reconstruct fully. You know, we basically averted a long downturn like the 70s and 30s, and a deflationary one at that after major bubbles, more like the Great Depression. I mean, that's a huge thing. And the biggest thing, stock markets, which I'll analyze more in November and look at. I mean, they are 2 to 4 times higher than they would have been without the stimulus. So this money went mostly into financial assets. And of course, that goes for real estate as well. With all this money pouring into wealth and with interest rates being suppressed lower, that also greatly boosted real estate and gave us 2 major real estate booms instead of 1. So this is a big deal, and of course the question is there a consequence of this? And I'm like, there has to be, folks, and we're going to find out in I'd say the next 2 to 3 years, and I lean towards this is going to be worse than people expect, because the economy since 2008, and that recession was cut in half of what it would have been naturally, has not been able to detox and alleviate bad debts and zombie companies, which is extremely important to keeping the economy healthy, okay? And I've been warning about this for years and years. There's a price to endlessly stimulating the economy. In other words, we really abandoned free market capitalism for the first time since it's been making us wealthy when it emerged in the late 1700s with Adam Smith, its original visionary, okay? So we just have to find out, and I can't know totally, you know, but I do think that this is going to back up, and we are going to have to deal with these massive debts. And to the degree we don't, it will affect the boom and career cycles of the rising millennial cycle. I've been warning about this for years and years. They're the ones that are going to pay because we didn't detox the debts and imbalances in zombie companies that emerge in any boom, but of the largest boom in history from the baby boomers. So I think the best way to look at the economy over the last so many decades is we've seen 3 major peaks caused by 2 predictable things, okay? The first peak was in early 2000. That was the first tech bubble. That's part of a 45-year cycle where we see 2 booms and busts about 22 and a half years apart. So that was the first tech bubble peak, and NASDAQ down 78%, way more than the Dow back then, okay? And barely a recession over that. Then we came, something I've been predicting since the early 80s, the peak of the entire baby boom generational spending cycle, the spending wave I call it, in late 2007, came right in late 2007 when it should have by my indicators, okay? And that's what triggered the 2008 Great Recession, and that looked like 1930, the first year of the Great Depression, until they came in with this massive, now 27 trillion stimulus program since to avert that, okay? Now, the final peak should have been, and we kind of saw that, between 2020 and 22, the second boom, the second wave of that 45-year generation cycle. So again, review, approximate 30-year generation spending cycle peak, 29, 68, and 2007. In this last 90-year, in the 45-year cycle portion of that second portion, okay, we've seen 2 bubble peaks, early 2000 and around late 2021 it ended up being. And what this whole massive stimulus, and you got to remember, out of this 27 trillion, 11 of it came just in the last few years since COVID. So this last strongest round hit then. And so we're seeing this final bubble peak, and that has been extended from 2021 into late 24 and could still be rising, but I think we're really at the top of this, okay? So that's where we're at. I mean, we have to resolve this. If we do not, then all these high debts, which many of them are not productive now, anytime you go into debts and investments, some of them will be very successful and a majority of them are going to be minor productive or unproductive. That's why the economy has to flush them out to stay healthy. So we couldn't be more unhealthy, okay? So I think we are going to see this big flush out. We're just going to have to see how soon and hard it hits. My best forecast is we're peaking here in stocks first and real estate to follow, and we'll see a downturn well into late 2026 and probably into 2027 before we flush this out, and then see the peak. And this is just the peak of the plateau, but the peak of the millennial impact around late 2037, and then a plateau off and on into 2050, 55. Okay, that's the long-term outlook. So we, first of all, we've seen the best of the U.S. economy with the baby boomers into 2007 and the 90-year most important long-term tech innovation cycle that peaked in 2020-21. Okay, so we go more sideways from here, and most of the developed world sideways to down, not as good as us anyway. But we first have to see, how do we shake out this cycle that never got to shake out naturally from 2008 to 2022, which should have looked like the 1930s. Okay, so again, I'm gonna obviously keep you updated on this. This is my biggest focus, and we have to see how this plays out since the central banks and Federal Reserve in particular has so overstimulated in the past. It's going to be hard for them to come out quick enough and hard enough, and they've just starting to loosen, and then they've been tepid about this, just 150 basis point cut. Now it looks like at best we'll get 225 basis points into the end of this year. That is a nothing burger, okay? That doesn't even bring us back to neutral at about 3%, 3.25%, natural Fed funds rate and stuff now. So again, this is a good time to be conservative. We'll see what happens and we'll read it from here. But odds are something's got to break here, and it's going to be hard for the central banks and the Federal Reserve to stay ahead of this game, okay? Because they already blew their wad by overreacting. And again, I keep saying, if you're going to stimulate and overstimulate, at least do it intelligently. Overreacting to COVID, which was a natural short-term setback that nobody would have blamed anybody for slowing economy for a few years, and then the economy would have got to clear out some excesses, okay? By overreacting to that, they really set themselves up for the crash of a lifetime. So that's what I'm looking for, and I will keep you updated.